Hello, accounting scholars. Hey, welcome to chapter 12. Hey, we're coming down the home stretch here. And this particular chapter, planning investments, capital budgeting, is probably one of the most exciting in the book. And the reason I say that is because the methodologies and techniques you're going to learn in this chapter are really going to be approaches that you can use in investment decisions that you'll be making over the course of your careers. But let's get started. What are we talking about here? Planning investments, capital budgeting. The short answer is these are techniques that you can use to make a determination on whether you should invest in an idea or a project. Let's take the example of Dr. Cook's coffee business plan. She indicated that she could secure approximately $1,000 to get the business started. You're going to be able to figure out, using the techniques in this chapter, whether she should invest that $1,000 and what kind of return she could expect. Now, you might ask the question, how's this done, Mr. Schwan? Well, in chapter 11, you became exposed to techniques that allowed you to take into consideration the time value of money. Well, in this particular chapter, you're going to apply those particular techniques. So let's start. We talked about the capital budgeting process. Again, not to overcomplicate it with big words, this is all about how to evaluate whether an investment made today is going to return the necessary funds in the future to meet the businesses or your personal objectives. But there are a couple steps that are involved in this particular process. The first is to identify the opportunity. And in this particular case, the way the process might work in a company, a department may submit a request. That could be a marketing department, could be the accounting department for, asking for a new computer. It may be a unique opportunity that may arise that the company identifies. And last but not least, it could be a situation where the company needs to expand. They need to build another plant in order to meet the demand for their particular product. So the first step in the process is the identification of the opportunity. Typically, businesses have more than one opportunity to invest in, so they have to go through a selection process in terms of which investments are most appropriate. The selection process uses the methodologies and techniques learned in our last chapter, which is to use the net present value or similar kinds of methods to identify the value of future cash flows today, because you're making that decision to invest today. Once you force rank the appropriate investments, then you determine, okay, how are we going to make this happen? How are we going to finance this investment? Are we going to use retained earnings from our business? Are we going to issue more stock? Are we going to go to the bank and take out a loan and use debt financing? And we'll get into more investigation of those particular alternatives in chapters 13 and 14. And then last but not least, once you have all that information, you make the decision, should I accept the investment opportunity and make the investment, or should I reject the opportunity? Okay, so once you do that, you then might ask, what are the steps that we need to take into account if we are going to use the net present value methods in this capital budgeting process? Well, as the graphic here shows, it's all about the future. And the steps that you would follow would be very straightforward. First, you would estimate the relevant cash inflows and cash outflows. If you were going to make an investment, how much cash is coming in the future, and how much cash is going out in the future. Then once you do that, then you would determine the present value of those cash flows using the company's weighted average cost of capital. And again, that's a big word, but essentially that means what the company's cost of money is. You essentially want to have a return which exceeds your cost of money or your interest rates. Otherwise, it doesn't make sense to make the investment. So using that particular weighted average cost of capital, and for shorthand terms, we'll just call this an interest rate at this point, then you compute the net present value. Very similar to what you did in the last chapter. Then the last step, again, is does this particular investment opportunity meet our hurdle rate, and you accept or reject the proposal. Okay, so we've taken the steps in the net present value method. Now we are going to look at what are the sources of cash inflows. Well, there's a variety of sources that will typically occur. The first is, from a cash inflow standpoint, cash receipts that would come from actually using the asset. An example of the coffee business, Dr. Cook would make that $1,000 investment in the business, and then she would purchase coffee machines, she would purchase coffee cups, etc. As a result of making that investment, there would be cash receipts, there would be sales of coffee, there would be revenues. So those would be part of the cash inflows. You would look at decreases in working capital. So you might use working capital as a source of cash inflows. You might sell old assets. This could be, you might have assets that you're replacing as a result of this new investment. You would sell those particular assets. Kind of like buying a new car, right? If you have an old car, you'd probably sell that to help finance the new car. Then you would have a sale of new assets potentially at the end of the project. Let's say with the coffee business, we said we're going to do this for 1 year, and then we're going to come up with some other type of business for the transition students the next year. Well, at the end of that first year, you would have assets that you purchased, coffee makers, tables, things of that nature. You would have an opportunity to sell those assets. And then there might be tax savings associated with a particular investment. Typically this occurs through the depreciation methods, and those savings are considered cash inflows. All right, guys, we are going to end this first one right here. Have a good night. Please make sure you've taken good notes and are ready for the quiz tomorrow. Good night.